feel like I should feel like I should feel like I should feel like I should go. Go. Feel like I should go. Feel like I should feel like I should feel like I should feel like I should go. Feel like I should go. Feel like I should feel like I should feel like I should feel like I should.
Hey, what's up? What's up? February 13th. Oh, well, tomorrow Valentine's Day, isn't it? And then you got President's Day. 2025. All right. So today is pretty interesting. Let's see what we got here. Very interesting. Very interesting. Let's see. Hong Kong yesterday hit a little peak, didn't it? Let's see. Hong Kong. Yeah. Okay. Interesting. Right at that 22 yellow line, 22,500 area. Huh. Okay. Could be the end of this journey for China right now. See if it pulls back. See if it follows my gray. And this gray stuff I just drew randomly, so it wasn't like come on, I don't know. Sometimes they work out, sometimes they don't, right? Sometimes you get something. Like here for MSTR, if it wasn't for that DeepSeek stuff, it's like I would have thought, okay, Bitcoin rises again, MSTR follows, hits back at 400, then short it. Nope. It already failed during that Friday before DeepSeek stuff. Yeah. So Friday, January 24th. Sometimes it works out, sometimes it doesn't, you know. You just have to scenario out everything. You can't predict everything. But right now, if we look at the NASDAQ, look at here. Look at here. We're up. Okay. Back to the old highs before Jerome Powell killed the market for the NASDAQ. QQQ at 535. Aren't we happy? So that's pretty interesting. What does that mean for next week or the next 2 weeks? So I call this video the eye of the storm. This is perfect. So I am not swing trading. Everything is day trading. Day trade. So if you have time to day trade, if you have the predilection, let's put it that way. And S&P, yeah, right at the back at the high. It's been hitting this high forever. Come on. How many times we've been hitting it? January 24th, January 30th, February 14th. Great. So are we going to go up or not? Or we're just going to sink and crash and burn? We have a 3-day weekend. Anything could happen. Anybody could release a bunch of news. I'm sure people are dumb and retarded. And so they will fall for anything. So that's why everything is just about day trading. Look at HIMS. So I mentioned HIMS several times this week. I said the top was probably where I got out Wednesday, February 5th. I said, okay, around here, near 45. 45 was what I got for the DeMark signals. And if you see on Friday, it popped above. And then for the last several trading days from that Friday, it's been trying to keep in that upper half. So if I just drew here a line from a channel, right? From the bottom of Thursday, the top of Friday, essentially, and you'd have a midpoint, and you stay above at that midpoint. And then yesterday, all of a sudden, it just kept climbing. I'm like, what's going on here? Guess I gotta watch it today. And boom, we opened up like 4 or 5%. Pre-market was 4 or 5%, and then we just went straight up. So after that whole PPI drop, and if you look at a lot of other stocks, I've noticed the same thing. You had Tesla. I mentioned Tesla for a couple days. This area 337 is important. It to survive that kept going up. Had a end closing that went back and retested that 337 and it opened up again. So yeah, like I said, I think Tesla's gonna do that. This thing here. I'll draw a squiggly line of what I thought Tesla was gonna do when it got here. Either it was gonna crash and burn. It didn't do that, right? So go up here, then go down, right back to 283. That's my guess. That's my guess. So you can trade Tesla. And if you're using long, you do TSLR, you get double the effect because it's 2x leverage. So if you got in for the past 2 days, yeah, probably about 15%, 16%, something like that. Tropes mentioned BBAI. Okay, well, I'll put this on the list too because I am looking at AI stocks again. So BBAI is one of them, but BBAI was already like it already kind of gave its it's kind of like hymns right now. You see that? You break out at this structure here, and then I could just draw another one. Here, I'll just draw this. See that? It's just doing this, right? So I mean, maybe it's done. Maybe this is already done. So I don't know about that. RX, however, we got this. It's been doing this little dance between 6 and 8, 6 and 8. Looks like it's trying to get out again of this box. Maybe if the next 2 weeks we have a big push up on the NASDAQ, the IWM, Russell, see you at 16. So you can make 100% here too. That's another potential. Sound. Yeah, maybe it might do another push. I'm not sure, but I'll keep that in mind. Peloton, I mentioned. Why? Why did I mention Peloton? So PTON. Because I can draw this here. I'll draw this for you. Okay. Blah, 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 blah. Oh, no, I don't want that. I keep forgetting where everything is on these things. I just don't draw enough. See that? So this is kind of like a creek. Okay. And then you can draw a little line here because you see this? These two areas. Tested, pump, go back, retest. So touch 3 times, pump up on earnings. Perfect. Now it's ready to go. It's jumping the creek. That's what they say, jump the creek. And we want to get above here, this area. Okay, let's see. Let's see how high we could go. Well, I could go to 17, I guess, up here. All right. Peloton could go up 17, so that's 70% potential there. If you look at ASTS, since Tropes wanted me to do, same thing. Same structure. You see that? You jump, you get jump out of the area here. You go back. You make a little channel. See, that's the creek. And now you're jumping over it. Okay, next move was going up. So let's see, how high can this go? Oh, we have no history. So once it breaks 38, we can go wherever we want, to the moon then. Okay, ASTS right there. Okay, what about WGS? We're stuck between this channel here. We've been hanging out quite well. So this is Gene DX. See that? Support. Support. It's rising again. Breaks out of 80. I guess we're going to the moon too, huh? This thing used to be a $900 stock. We got a lot of potential there. So yeah, if the market is going to be stupid, it's going to go crazy. There's nothing holding it back. We'll see you. We'll see you at the top here. All right, so those are the main ones I wanted to talk about, and we had SMCI too. This one was perfect. Okay, so if you guys played with me from last week, right? Last Monday, you got here 25. You got, well, I jumped out at this area and I was using SMCX. So I was like, oh, okay, I made enough money. Forget that. So I went from 26 to 50. So that was 100%. I'm out. I was selling along the way up too. It wasn't perfect 100%. And I bought back a few times during these days. But anyway, it was pretty much the full race. Then on Monday, we got another gift, and you could I could have day traded that too, but today I day traded. So I waited for the earnings, and today we went down 5%. So I had to jump out multiple times. I had to be really flexible with this one. And yeah, trading is not easy, guys. So I said, like, I get in here, right? And then I set a stop loss probably around here. So if you're using SMCI, this is what you would have done. You would have got in around maybe 39-ish, 39, as close to 39 as possible. You're not going to be perfect. But then the morning you get flushed out, right? And then what would happen is if you go on the 13-minute candles, then you would try to look for, okay, there's some volume coming in, and then you got 2 green candles, you got to jump back in. So if you got flushed out, you got to jump back in before this monster green candle. Then you're just like, okay, I'm riding it all the way up here to the top because this was 43 is the top. I got out. Now I'm going to see what's going to happen tomorrow or next week because I think this thing wants to go up to 60. Yeah. So if the market really is juicy, real juicy, you're going to get 50 to 60 on this SMCI, right? And if you're using SMCX, yeah, you got plenty more to go. So probably 120% if you get the full ride. Yeah. Let's see. So 40 to 60, 67. Yeah, roughly 50%. So you get 100 something percent for sure. Okay. All right, great. What's another one? T-Doc, Teledoc. Okay. This is like a more mature version of what's the other two I was talking about? DNA, the Ginkgo Bioworks. You see this? It got to get out of 16. So I bought some today. I came back in today. It already went up like 10%. All right. So I'm holding that one. See what's going to happen tomorrow. And then so if we look at T-Doc is like Hims because they do telehealth. So Hims is not just like making generic Ozempic or whatever. But oh man, yeah. Okay. And this huge red candle. So it can go to 13 to 20. I don't know. Can it do it before earnings? Earnings is at 26. Man, I hope this can. I don't want to play earnings on this thing. Yeah, I just want to get in and out here. Maybe this thing can go from 13 to 20. Or at least maybe even 22. Okay. Yeah. This one I'll put on my list too. All right. Okay, so there's a lot of stuff. A lot of tickers, similar looking charts. You got charts that are making cups and bases. You got charts that are popping out of their creeks, like ASTS and stuff like that. So you got some that are just about to break out of their channels. Some that already did it because of like Affirm. See that? Affirm. It's getting ready to move fire. We have Upstart pulled back today after earnings, but still above the resistance. So UPST. So yeah, there's a lot of stocks have similar looks. And in the next 2 weeks, you can make a killing right now if you just pay attention to these stocks and see what's the right place to get in if you're sure the market's going to go up. I can't guarantee. No guarantees. But the way it's looking right now, so if it doesn't crash and collapse after President's Day, I don't know what's going to happen because we're done. There's no more inflation data until the last day of February. Okay, there's no more inflation data. You're clear. Tomorrow there'll be retail sales. I don't think that's going to do anything to the market. Maybe it might, but who knows? The only thing that could happen is Trump says more tariffs or something. That's it. But we're clear. We're ready to launch. Everything's in rocket mode right now. Jerome Powell ain't going to talk until the end of March or whatever. So he's not going to do nothing now. So who's left? There's no big earnings anymore. We're done with earnings. Okay. So I'm going to play some videos from the Wyckoff guys, and you guys can see that. Yeah, I don't know. There is a seasonality, Duale. Like February is seasonally bad. I guess. Is it? I don't know. And yeah, King TL, you got to watch all my October streams or something. so anyway, yeah, but All good, all good. So let me play these small videos for you. Then you can decide. So these guys think there's going to be a big drop at some point, and then I'll play Samantha Leduc. Samantha Leduc thinks we're going to pump into April even. So you see, you get these conflicting messages, right? You get these conflicting messages. So I think we're going to go up and then down, but the timing, you got to be right. You got to be really right on the money. Okay, let's talk about Bitcoin first.
We had a lot of volume around the top, and since then the price action has not been able to recover. So there's selling here, and this bar is very peculiar. We have seen some demand, but we have no follow through after this bar. So if we have so much demand on this huge demand tail, why the price action is not able to push through the former resistance level? On the contrary, we are still making tests in the lower part of the range, and this bar, this attempt to come back on high volume to the previous supply zone is very disappointing. So it's very suspicious, and if we fail here, we could easily create a deep shakeout below this level.
Yeah, I agree. I agree with that. And that's why, like, I think last week I was considering I would short MSTR. If Bitcoin was ready to drop like this week, just short the heck out of MSTR. But it didn't happen. It tried several times to hit that support and break. It failed. Nothing conclusive either way. So no trade there. But let me show you the MSTR and Bitcoin and all that. Like you see here, look at all that, all those candles. Here, let me give you a cleaner chart. This is too noisy now. See that? So I drew this rectangle. It just keeps trying to puncture through it, but then it bounces back, and then it falls back, bounces back, falls back, bounces back. No continuation. So the bar he's talking about is this one. You see, this last major green bar with a lot of volume. No follow through, right? Immediately rejected with a red bar on that Tuesday. So that was last week. So yeah, nothing so far. No trade here. But if you look at the MSTR chart overall, it's perfect. It's ripe for a short. Everything's weakening. The daily chart shows, yeah, ADX is about to go up. We have red DI here. Everything's set up. MACD's below zero. The weekly here, we're touching that rising 18 weekly moving average, and now we're underneath it for this week. So it wouldn't take much to just cut through like butter. 294 all the way back down to 227 and 196. Okay. Yeah, that's a potential, but maybe not yet. Maybe everyone's expecting that. People short down here, and then some news happens. Trump says something, and then all those shorts get squeezed, and this thing runs all the way back up to 380. And then that's the real time to short. Oh yeah, Antoine. Yeah, I don't know. Yeah, there's a lot of things that could work with options. Depends on too many variables, like how it moves, how fast it moves, where you put the strike, like the premium that you paid. No, it's multi-dimensional. It's not, it's not just like, oh, I just know what direction it's gonna move. What the direction is, what time it gets there, the volatility, like how big these candles are when it gets towards there, and then all this stuff that goes into the option. So yeah, you're gonna have to I mean, Dennison kind of says like the way he learned it was through trial and error. A lot of other people would say like, no, you have to read tons of books to understand it fully, know all the mathematics behind it. Okay, that's like, maybe that's too much overkill. You shouldn't need that much to do it. And then Samantha the Duke has this like free website, or not free. I mean, you're gonna have to sign up. I don't know if it's free. Yeah, yeah, it could be beginner's luck and all, and makes people, and then they don't understand what they're doing. I don't know. So, but yeah, from first principles, at least you should know where things are, and then from there you could guess where things should go. But then you build a trade from it. Like let's say I don't know what's gonna happen, right? And there's earnings tomorrow. I could put an option like bet, and I would only lose the amount that I put in. Like I put $1,000 in an option, even if the price of MSTR tomorrow goes to 295 overnight, I'll be okay. I only lost $1,000. But if I bought the shares, so there's a lot of benefit to using options. You can limit your losses if you do it correctly. If you're not doing it correctly, you just keep losing again and again and again, and it just bleeds you slowly, right? So over time, you just keep losing because you're not understanding how options work. So then that could also mess you up too. You're not getting the right price. You're not picking the right strike price, or oh God, yeah, there's so much to it. Yeah, it's painful, man. It's painful. Yeah. So there's a lot of benefit when you know how to do it. I'm just so lazy. I just like, I don't want to read all these books, man. They're huge. Yeah, they're all free too. There's tons of them. And even then you don't know what you're doing. After you read it, you actually might be worse off after you read them. You're just like overthinking things, right? You're kind of like, wait a minute. Was the beta right? Wait a minute. Was the alpha right? Was the theta right? And you have all these variables in your head. Dude. Dude. Actually, so I played one of the videos with Martin Shkreli. Martin Shkreli said he used the AI to write code for him because he's not a good programmer, but he used the AI to help him write a program that could analyze options for him. So it would like pick out which options were the best to use. So that's great, actually. If I think that will help a lot of people if somebody made that. Yeah, I think John could do it. I mean, because John's played options already, and he passed the CFA exam level 1, level 2. I don't know if he did level 3, but he did level 1 and level 2. So he knows he could do it, and he could just mess with the AI and make code for him, and then he can sell it to everyone. Be like, here, this is how I make a nice little generator to look through all the options contracts for you, pick out what's the best play to make with those options. And then you just use the charts to figure out where you want to go, right? So let's say I use MSTR. I think I'm going to go long for next week. Then I could set a strike price and figure out what the pricing is, the models, and I say like how much volatility I expect or something like that, and good to go. Then it will automatically choose which option to buy instead of me randomly picking, oh, let's pick that option. And then you just don't know what the hell you're doing. That shit. Crazy. But yeah, you can make a lot of money really quickly. Yeah, Antoine. Yeah. So it's not hard, especially when you have very little money, Antoine. That's why when I started doing trading, I already had a bunch of money. So I didn't feel the need to learn that. The only painful thing is that I have to be very good at chart reading. So I spent most of my time trying to improve my chart reading before I really got comfortable putting big bets. But when you do options, yeah, you can restrict and limit like, oh, how much I can lose. So that really helps. That really helps in certain cases. Yeah. So that's a whole nother game. And the other way is futures trading. Futures trading is another way. And but then you're limited just to the index. But then you can play other stuff like gold, natural gas, silver, and corn, coffee, chocolate, cocoa, basically. Yeah, you have a lot more options there too. And when you do futures trading, when you sell, it's always taxed the same way. It's 60% long term, 40% short term. Okay, so when I trade futures, it's always treated that way. Whatever I make, I could do day trading on futures, but it's always taxed. 60% of my gains is long term, 40% is short term. That's great. If you make huge amounts of money just trading corn or something or natural gas, you're just like, fuck, man. The tax treatment is amazing. They give that same treatment for options on the SPX. So if you do options on the SPY, you're not going to get that treatment. But if you do the SPX, but then if you use XPX, I think the thing is that you have to pay a lot more money per contract. So then you don't get the benefit of using the E-minis. See, that's a whole nother level, right? Now you're trying to figure out, hey, what tactics do I use to avoid taxes in certain sense? Yeah. So there you go. Interesting stuff. I'm sure eventually they'll have futures for every stock out there. They'll be like every popular stock, like Tesla, will have a futures associated with it, and then you can get that benefit. Who knows? That could be coming around the corner, especially with the way that Trump's going to change the SEC. And if you see that stuff, run away, because that means the whole stock market is going to become the gigantic casino that it's already a gigantic casino. But then once you introduce all those things, oh, everyone wants to play now. It's like it's going to be sports betting for everything. Yeah, that's what it's going to be. Okay. Let me see. Tesla, talked about that and all the other stuff. Yeah. And I'll have to look at some books to recommend for the options, but I'll show you the Samantha LeDuc. It says free on there, so I don't know if you have to pay, like you have to enter a credit card number or what, but it says free. So let me see. Samantha LeDuc trading. Okay, 3-part options course here. Okay, Antoine, check it out. Check this out. I don't know if it's really free, but see if you can get in and get the 3 free courses they got here. And if you're if for people that are really wealthy, I recommend like Samantha's stuff anyway. Like she's like the best out of all the people that does it. So yeah, there's an options course right there. So I'm not sure if it's really free. It's like, oh, well, if you don't cancel a subscription, blah, you know what I mean? They always do that. Like, yeah. All right. Alrighty, guys. So Bitcoin, I talked about that. Let's go to the next video. Let's see what else. Video. What's the other video? Gold. Oh, yeah, gold. All right, gold.
Let's just quickly look at gold. We're talking about this breakout right here, and look at the gap. So in itself, it's a strength, and it's into the resistance that we're seeing this type of gap. Then we have the very good extension on the significant bar. Does not require a lot of effort behind that. Then we have, again, a touch and right away reaction after that. So we said that we're going to continue. We do have somewhat of the climactic bar right here. Supply is coming in. Demiet is here as well, so it's an attempt, obviously, to hold. I would be thinking that we're somewhere close to the end of this swing, and then we're going to have a reaction. Because of the strength, there might be another attempt before we actually react. I think that we're going to react mildly, somewhere into this bar, not necessarily all the way. There is a lot of strength, Bruce, for gold.
So, yeah, I think short term we're going to have a pump up on gold. So if you saw today, I'm going to talk about PLG Platinum. So there's a platinum miner. Oof. We finally got it. So I was buying this sucker at $1.24. Been waiting. And all of a sudden, February, okay. February 10th, we got one push. All right. Then now Wednesday, February 12th, we got another. Today we got another. Is it ready to go back to 2? Is it ready to go back to 2? Because I want to see it. So if you do PLG, that's the miner stock. Now if you do SPPP, is the trust. So this is the actual platinum palladium trust. You hold platinum and palladium by buying this trust here. They hold it for you. And it is moving up. So platinum and palladium have been moving up. Gonna see what this Russia deal is gonna do to it. See what happens. I don't know if it's a good thing or a bad thing right now. I don't think you want to have a deal, but if Trump has a deal with Russia, then this might be bad for it. I'm not sure, but I'm sure there's a lot more demand for platinum palladium anyway, regardless of what happens with Russia. If we keep the the sanctions going. So that's one thing to watch with the Russia stuff. Let's see what else. So gold. Yeah, I talked about gold already. We already hit the area where I think it's going to stop for the gold miners. Here, 42. Yeah, 42 about. Yeah, this is the range we've been. We're going to try one more time to break out of here for the gold miners, silver, EXK. Yep. So it's back at 4. I don't know. Let's see if it comes back to 5 or something, and see if it goes further. But it could be it. It could be over. But you never know. You never know. This could last. This could last through April. So we're almost at 3,000 for gold. Silver is the lagging one. I think we're still at, yeah, see, we're still below 35. So we're at 32 right now. 32 an ounce for silver. Okay. Last video. We're going to talk about the S&P 500. Okay. And then I'll talk some TGA, the Treasury General Account stuff. So this is where they differ, okay? So this one is a bearish outlook.
I think in some situations, this could be the prelude to the shakeout, like to around maybe 5,700. It's with the absorption, if we're truly absorbing, it should start changing also the character of the structure, because the character of the structure is still this. You see that?
Yeah, it feels heavy, like they're selling into it.
I was playing around with the analogs in my memory. What have I seen this before? Like if I'm thinking that the shakeout is here into still an uptrending environment, like if it has a shakeout into this level like this, and even slightly lower, like to 56, that's just right to this level. It's still of the same volatility as this. It's the test of this, depending on how we behave in this area, obviously. But if we have something dynamic as this, it's still going to be to the upside.
So not necessarily bearish, but he's saying like we got to drop sometime soon, because I don't know if we got a 3-day weekend, or if everything goes well and there's no crazy news that happens over the 3-day weekend, and then we get into Nvidia will have the results. That's the biggest tech company left to talk about, and it has AI, right? You need Nvidia to have good results. So this is going to be on the 26th of February. So you got 2 weeks. 2 weeks. So it could happen then. Maybe that's when everything collapses and drops down. So that's what I'm watching. But we have 2 weeks at least of goodness. We don't have to worry for 2 weeks, hopefully, after this long weekend. So that's what I'm hoping for. Every day we have a day trade to go with, or at least maybe a potential swing trade. I'm not sure yet. I need to see more proof. Okay. And I'm going to play this video with bullish is up, bearish is down. Yeah. Bullish is up, bearish down. But it could be bullish is down too, because we need it to go down first before going up. I don't know. I haven't decided. But we've been doing that for the past, like, whatever. Oh man, it's nearly 2 months now. Yeah, we're in February already. So I've been saying investors will hate January. They will hate it. Right? I said, bruh. Everything is for traders only. This whole past 2 months have been great for trading, terrible for investing. So let's look at one of my long-term stocks like Axon, right? So earnings will go up. After Thanksgiving, feels good, makes new highs. And then Monday on December 9th, well, so somebody's starting to sell off. I guess maybe they're selling for taxes. What? I don't know what's going on here. And then it's just dropping. And then even the New Year's, they're still selling. It's just like, oh, great. And then after we hit a little patch, and then everything on January 13th, since then, back up. Oh, now we're back up to the same old highs as February 7th. Now let's look at another one. Let's look at another long-term stock that I'm not in this one, but this is the one I've always highlighted as a best example of a beautiful chart. It's a beautiful chart. So went up from Halloween up until December, first week of December. Again, we hit a top, and then all of a sudden, Monday, December 9th, drops. And then it keeps on dropping, just like Axon, right? Drop, 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 drop. Oh, man. December 31st, we hit a bottom. And then New Year's happens. And we just go straight back up, 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 like to a new high. So if you just zoom out and just look at, okay, daily looks like this, right? And then let's go to the weekly. So this is the first time this stock, Sprouts Farmers Market, SFM, had a nice large red candle. It's been a long while. You haven't had a red candle like this since, let's see, May 2023. So from there, it went from 31 all the way up, up, up. And so it's been going up since the bottom here of December 31st. And then you got to New Year's, and then it went up 40%. Oh, great. So I have no clue. You know, it depends on the stock, right? And then you look at Carvana, 6,000% if you bought it 2 years ago. All right. So I did buy it at the bottom, but I got out at like 14, 15. This could have been my second Palantir, but I decided to put all my money in Palantir and not waste my time in cash to put it in here, because you know you have to decide which stocks to go for your 1,000%. I could have split my money and decided to do both these stocks, but Carvana seemed like come on, it's used cars compared to tech. It's just like tech is probably going to do better, but now yeah, see it. Even though it pulled back here to $7-8, I should have got in once it started doing this again. Once it did this, it's like, ooh, yeah. This is a big, significant turnaround. So if you look for stocks that have been beaten up like this, a lot of times they don't need to do anything else other than prove that they're not losing as much money as the previous quarter, okay? It doesn't have to be a good company. The company just has to show that, hey, we're not as bad as we were several quarters ago. Because as you can see here, red earnings, red earnings, red earnings, red earnings, red earnings, red earnings, then green, 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 red, green, green, green. So you just need a turnaround. So if you look at Peloton, I don't care about exercise bikes. I don't think this company's great, but who cares? As far as a stock is concerned, you see here, red, 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 because it's after COVID. Nobody wants to buy exercise bikes. They're not staying at home and buying your overpriced exercise bikes with an iPad slapped on it. But you had earnings here in August, and it turned around. So now they're not losing as much money as they used to. So now it's up, 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 up. So this thing, you see here too, you have a creek. This thing's great. This thing is like a Carvana. I don't care if I like this company or not, but the stock has potential. This thing could just shoot all the way back up, especially if interest rates start moving down. I don't think they'll move down this year. So this stock might not be ready for prime time, but maybe late 2025 into early 2026, there could be a bubble where we have. So usually the stock market, you're going to have a nice big bubble at the end. Yeah, you're going to have a big, nice bubble, and you're going to look for trash stocks like these to fly up to the moon because they get overly shorted. People short it way too much, and it's been beaten up way too long. It just has a snapback. It's like a rubber band. It'll snap back, and everybody will just be scratching their heads like, huh? How can a company that makes no profit, has no real growth prospects, just snap back all the way up and takes back where it was? Like, let's look at another one, right? WGS. Look at this guy. $800 goes down to $2. Now at $80. Well, welcome to the stock market. plenty of examples. So that's what I'm looking for. Actually, if I'm going to talk about Mobileye too, Mobileye, same thing. You were at 45, you went down to 10, now you went up to 20, pulled back to 15, back up here to 18. I think this thing can go back to 30. So another one you can look at as well. So Carvana, I'm just telling you about Carvana because it had a sell-off into the end of the year. So people were probably taking profits. They didn't want to wait until New Year's. And this thing just recovered right away. We're right back where we were at the top of here just before Thanksgiving. So that tells me there's a lot of juice still in the market. The market has money floating around. So we have to look for the next ones. And the next ones could be natural gas. So Williams reported earnings. Williams Company. So you got that one. So it's been dancing at this top right here since November, right? Dance, 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 dance. Ready to go? Is it ready to go? Ready to break out? And then we have like this AI stock, Nancy Pelosi stock, and it looks like it's just because people found out she was in this stock, they started buying it up. So from 44 to 83. So perfect timing, right? Perfect timing with the market. And now it's at a new high. So where's this guy going? So TEM. I have no clue what this does. Tempest AI. It just has AI in the stock name. As long as it has AI in the stock name, it's going to go up, right? Because anything right now, if the market is juiced and people are happy, we're ready to go. Because NASDAQ, we're at the high, we're ready to go. So this is what I'm looking for. I'm looking for the most trashiest of growth stocks. I want to see charts that look like this because I just want to ride it up. I don't care about them. I just want to trade. So we got a whole list right here. TDoc, Tesla, BBAI, RX, SOUN. Got it all listed on the banner underneath. Watch them. Put them all in there. Nancy Pelosi. So Antoine, you can go look it up on Unusual Whales. Like they have, but the problem is like, you know, by the time you know what the Nancy Pelosi stock is, it's too late, right? It's already a month over. It is good to tell you what things like people might be about to do because Matthew Berry or Michael Berry, I think it's Michael Burry. Like, so he was doing a lot of the Chinese stocks. He was getting to a lot of Chinese stocks last quarter. So now you see like Baba up, right? All this stuff. And he's in Baidu, he's in JD. My stocks are like for China is KC, Futu, FUTU, TIGR, Up Fintech, BYDDY, XIACY. Okay. But yeah, but him, like he's going for the mainstream tech Chinese companies, the top three, Baidu, BIDU, JD, and Baba. So he was pretty right on, huh? He was pretty right on about like what's gonna happen. Anyway, so let me show you the website here. Let me share the screen. Okay. Right. Yeah. The same usual suspects, but the TEM was new. Yeah, so the TEM was very new, and it's very small cap. So once you got that, and once people, but it's like self-fulfilling prophecy, right? So once people know Nancy's in there, then they just jump in and go in there, then then yeah, it's gonna go up. So it's like so from that standpoint, it's like, huh, all right, whatever. So it's just like, okay. Here, let me see. Oh man. Okay. Let me see. My Michael. Okay. TGA. Let's see. Okay. All right. Yeah, what's up, badass? What's up, Jewel? Okay, so stop my screen, get my screen up. So yeah, there's this website called Unusual Whales, unusualwhales.com. They got a lot of nice stuff here too. Yeah, they keep increasing their stuff, but let's see what the free stuff is. They should have like the whales listed, so you can find all the whales. Blah blah blah. They got Greeks. Oh man, they really add up. They got Discord too now. Yeah, they got the political trading. How about that? Here we go. Maybe this is it. Yeah, here we go. See? Let's see. Then you got like all the Democrats listed here. You have all the Republicans listed here. Yeah, very nice. Okay. Okay. Let's see. All right. There you go. Nancy Pelosi, our favorite, right here. Buy, sell, buy. Yeah. So 117 is the date reported. So that was the date that you know about the trade, right? So these trades happened 114, so 3 days before. So those were the last trades. And then some of the other trades were way late, like during December, right? So sometimes they're nice like this, and they'll give it to you at least 3 days. Not bad, because if you notice, like, look at her. She did it at 114. Why 114? Remember, January 13, what did I say? Buy everything. And of course, they know when to time the market. So, of course, when they saw the candles on Monday the 13th, that was the time to buy. So they were already planning to buy those stocks, and that was the best time to jump in. And why not? But by the time you figure it out, it's already the 17th, right? So, yeah. So it could be a big deal, especially if you do options. It's going to be a big price change. So there you go. Anyway, so you can go to the website here, Unusual Whales. Nice website. They got all kinds of stuff there now. There's probably some other ones like the F filings, or I forgot what. There was another website that had all the F filings, or I don't know if they do other ones. Let me see. Yeah, let me search for it. F13 filings. Is that what they call it? Let's see. Oh, 13F. It's called 13F. I don't know. This has to be a. Yeah, Fintel. I think I used Fintel. There's probably another website that can do this thing better. Here, let me unblock Cloudflare. So this is Michael Burry's management thing. Let's see. Oh man, Cloudflare net. Cloudflare is net. NET. That's a ticker symbol for Cloudflare. Oh boy. Am I a human or not? I guess I'm not a human. Man, I put too many ad blockers on this stuff, so I can't use that. Here, let me show you. Here, I'll use a non-ad blocker tab here. All right, so you can go to this one, Fintel.io. So you get Michael Burry, and then you have the holdings, and then you have the last filing dates and things like that. Okay, so I think you have to pay money now, huh? Damn, okay. See, what's the holdings right now? See? Baba, JD, Baidu. There you go. That's what he holds right now. Okay, so you can see how much of his portfolio is with this and that. Here you go. Have fun, guys. Yeah, you can go there. EXR. What's EXR? Okay. Extra space storage. Is that what it is? Extra space storage? All right. Okay, so here you're gonna go to we have been with them over 15 years. 15 years, huh? Okay. All right, keep that in the list here. All right, put down my notes. Extra space storage. All right, so here you can look at Fintel. You can look at that website. You can see other people. I think. I guess they charge you money nowadays, huh, for this stuff, information. All right. Okay, so I'm gonna talk about the TGA. So let's play the video first. Hopefully, you guys watched some of the previous videos. I explained the liquidity stuff, but I'll go over it again after I play this video.
The 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Read my trading room notes every day because there's also macro built into this. We have jobless claims. Just a reminder, we've got Powell. Let's go Powell today at 10 o'clock. That should say AM, not MA. We got CPI tomorrow morning. We've got jobless claims Thursday morning. We've got weekend de-risking, tariffs and all that usually. We've got a long holiday with President's Day on Monday. We've got OPEX next 21st, Friday, and really, we've got NVIDIA, which is 226. So this is, technically speaking, we're just a big world of chop, and we need to make a decisive break out or break down. We definitely have lots of headline risk, but we do have a structural flow that is bullish in addition to option flow, which is still bullish. Yes, they can change their mind much more easily than most, but option flow is still very bullish. Structural liquidity flow is still very bullish. And that's my focus that I wrote about with TGA, which is a Treasury General Account. And it is so bearish, meaning this little puppy is coming back down into the August debt ceiling. And I had a conversation with a colleague, and he was pointing out that all things being equal, because he asked me about my call, and I'm like, I'm very bearish the second half of the year. Right now, we're not going anywhere. So very much bearish the second half of the year. And he's like, well, that's where we would get the debt ceiling. And they can't really do much until then. So Besant saying, yeah, we're going to keep the current levels for the next few quarters is because he has to. So he's much more into the weeds of the TGA projections, like really into the weeds. And he's also a Bitcoin bull. But the point is, this is his analysis that TGA will run down, and it's so bearish, it's bullish, meaning it puts liquidity in the system. It's not going into markets specifically, so don't get that in your head, but it's definitely supportive for those who understand the macro, the TGA, and how Fed and Treasury support and backstop, for most part, the banks. So they are literally paying banks who lend them money to buy bonds, and it's all very much a closed loop. But this is also part of the support that we will get into the market until the debt ceiling is resolved. It's either removed or moved higher or whatever. So Besant, long story short, can't change the issuance. And that's the one takeaway I didn't get. I know the drawdown of RRP, and there's lots of doom porn, and I hear all the mistakes on TGA. This guy knows this stuff. And there's another one who's really, really good with it. Craig was also really good with it, and he also posts that. But he's getting his information from John and Jacob and others who are very, very focused on the weeds. Anyway, long story short, this I didn't realize. Percent is not going to be an issue each quarter. He's not going to do anything until the debt ceiling changes. So that's a really big takeaway for anyone who's macro inclined. Anyway, so long story short, we have, he says, flood of liquidity that's coming in starting 212 to 410. This is why I love having colleagues. I didn't know this. Did you know this? No. Am I supposed to know this? This conversation with him was gold because, one, I didn't realize Becent can't change a dang thing, and we're going to get a flood of liquidity in starting tomorrow. Now, it doesn't mean we move straight up. That's what I really, really want to emphasize. This is very supportive for markets, but it does not mean that they go directly into markets. So keep this in your head, please, please. But I want to just kind of highlight, this is really important stuff if you're trading the next 2 quarters. And I think it was you, Marshall, who kept beating me up. What's your view? What's your view? And I'm like, well, we got to get out of this mosh pit, up or down. We're just going sideways violently on every headline risk. It's really hard. Well, this helps me give a little bit more of a bullish backdrop, because you also know I'm still bullish semis in NVIDIA. God help me. But the point is, I don't think this is done. I don't think this market is done. I think this is a topping process, and I think we're going to get very much, it wouldn't even surprise me, and hopefully Marshall's here to hear this, because he was the one that was really ribbing me yesterday to come on, make a call for Q2. Anyway, the point is, wouldn't be surprised if we get support here and then a shake and bake in April, and then a little bit more support, and then a little bit of a bounce. I'm sorry, that's a bounce. That's a little shake and bake, a little bit of a bounce until we get into August. And then we have the seasonal volatility of that period as well. All right, I'm also, as you know, I'm updating trades here in trading room notes, and I will have just a reminder, take a look here, because this is really working. I mean, China's having a little pause today. Metals, mining, all that stuff sized up last week before the tariff threat. They just looked gorgeous. And like, be careful on gold and GDX. It's definitely extended. And even individual trades, which I love when clients bring them to my attention, like ASTS last Tuesday ran $10. I know nothing about ARBE, but that was a new one, and that was client recommended. These are hopping. So anyway, definitely check out trading room notes, please. You've got the gist of my macro daily market thoughts and the trade ideas.
All right, so yeah, Jewel. Yeah, she likes using shake and bake. I think she's from Texas too. I'm not sure. She has a farm or whatever. Yeah. Anyway, so yeah, she has a really good group of people, team. So it's kind of like, from out of all the people that have like their own little trading group, like she has the best one I've seen. She got the Discord, she has the Slack, she has all these things set up, a mix of old people and young people. So people that do the macro stuff, more boomer, Gen X, and then she has all the young kids too trading. So she has a good mix of people. But then if you're going to pay for her services, it's like $1,000 a month or something like that. It's like for the big highest packages. And I would say if you have a lot of money and you want somebody to manage your money in a way that's very dynamic, right? I would say like she's probably the best one, because she can tailor the stuff for you. And overall, if you're really rich, $1,000 a month, somebody to manage your money in a way that she does, I think it's worth it. Yeah. I'm not that level, right? I try to give you like all these, try to high level picture, chart level picture, the charting, and I do the cycle analysis and things like that. So I try to like give you all that stuff for free. But yeah, she's next level because she has a whole team behind her doing this stuff. So that's why I said, like, so I told HB like this week when I was on one of the panels, and it was just me and him, I think. And I just told him, like, you know, if you just got a bunch of people that thought this, like, you don't have to think the same way, but at least like you have people that know charts or believes that charts can work. And then you have people that have different specialties, or they track different sectors more specifically. Like one guy is just doing biotech, one guy is just doing industrials, one guy is just doing, or certain, like, or earnings, or maybe some guy just wants to trade earnings, or yeah, you have different people doing, or one person does commodities, right? Futures trading. If you have a whole team set up like that and they all work well together, it's like, it's really easy to make money. A lot of money. A lot of money. Yeah. So for her, I think when she does a lot of the options trades, she shows you like 10,000% gains or this and that, like really crazy stuff. And I like when she just does everything overview, because I try to emulate that. Like she has that macro viewpoint and then tries to do it with the charts, which very few people do. A lot of macro guys, they don't time anything right. They just say, oh, like, you know, I played, yeah, Jewel, you were here. I played that dude, the Bond King, Jeffrey Gunlock. Like he's always a downer, right? Oh man, the market's overpriced. Everything should crash. What's going on? Blah, blah, blah. Buy bonds, buy bonds, buy bonds. If I thought like that, I would not make no money, because I am too poor to be buying tons of corporate bonds or whatever and be using the interest rate to make me money. Right? That's not going to work for me. So like, yeah, you need a real good mixture, real good flexibility. Yeah, you need a real flexible person. So when you encounter a lot of the macro people, they always look at these big picture things. And if I have time today, I might be able to. I'm gonna go through some real estate stuff, so you can see like, ooh, can we time the macro? That's always going to be good, because that's going to be very important in the coming 2 years. All right. So for now, let me go over what she said. She was talking about the TGA and said there was an injection probably around yesterday and going into April the 10th. So let me go over and review with you guys what I was explaining. So this was written in 2022, I believe, by Max J. Anderson on a tweet. And this got people really, really thinking a lot about how the Fed and the Treasury works here. And I've read this already before, but I'll read it again. Something magic happened. Oh, well, I think this guy's Swedish or something, so maybe that's, you can forgive the grammar here. Something magic happened in July 2020. Since then, you can predict the future with 95% accuracy. It's worked perfectly for over 2 years, and 1% who know have made billions betting on it, but nobody else is paying attention. Here's how you can use this too. You heard the Fed balance sheet and the Fed funds rate and how they've been the central driver for markets for decades. All right, so I'm going to skip ahead because I already read this already. So we're going to go see. So the Fed injects money. Okay. So here you can look at the assets, less eliminations, consolidations, and then you have here like deposits, liabilities, U.S. Treasury. So this is the Treasury Department. This is the Fed. So they were both during COVID injecting money, and that's why you got your egg inflation right now, I guess. Well, part of it. I mean, unless you're going to say the Fed created bird flu, but whatever. But here's the important part. Stocks go up, stocks go down, and it's based on the TGA. And you saw the graph that Samantha was showing. TGA goes down, stocks go up. Okay, so TGA, what is the TGA? Right, this is where the Treasury gets its money from. All right, so the U.S. Treasury sets down its margarita and beer bonged a fifth of the financial tequila to the face, provisioning itself with $1.8 trillion, 4.5x has ever done. As it deployed that 1.8 trillion, something remarkable happened. The fire hose of money coming from out of the Treasury was so big, it became the sole driver of markets. Liquidity took over as the only thing that mattered. So the S&P 500 snapped back into perfect inverse correlation with the TGA balance. So that's the Treasury General Account. That's what the TGA means. So eventually things got out of hand. The flood of liquidity drove the cost of living for Americans 33% higher in under 2 years. It was a runaway shit show with no signs of slowing down. Okay, so you can see housing. Actually, yeah, if we have time, I'll go through the housing market after this. But in any case, the thing is that you have to just understand this formula. Fed balance sheet minus the Treasury General Account, the TGA, minus reverse repo. We talked about reverse repo several times already. You're going to have to go back. I'm not going to do it this one. I'm just going to focus on the TGA right now. Equals net liquidity. Okay, so we got to go down here. This is another article I read already. And these are in the description. Okay, these links. So we can go down, 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 down. FOMC, this and that. Okay, the mechanics of fiscal dominance. Fiscal dominance arises when fiscal priorities, namely deficit financing, dictate systemic liquidity flows, reducing the effectiveness of monetary policy as the primary driver of economic conditions. At the heart of this shift lies the Treasury General Account, TGA, the Treasury's operational account at the Federal Reserve. Traditionally a passive tool for cash management, the TGA has become a powerful lever for liquidity, reshaping the financial system's inner workings. This is not the first time fiscal dominance has shaped economic outcomes. The post-World War II period offers an early example when the Federal Reserve was compelled to maintain low interest rates to accommodate the government's massive borrowing needs. This era saw inflationary pressures emerge as the central bank's ability to act independently was constrained by the sheer scale of fiscal requirements. Similarly, the inflationary surge of the 1970s highlights how expansionary fiscal policy combined with monetary policy accommodations can lead to destabilizing price pressures when fiscal priorities take precedent. Well, are we heading into this era? Fast forward to today, and the dynamics are familiar. During the recent debt ceiling standoff, Samantha mentioned debt ceiling, the Treasury was forced to draw down its TGA balance, injecting liquidity into the banking system. Bing, 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 bing. That's what she said. That's what she said, which is great for me, right? Because I'm going to trade and hope, like, if I buy SMCI, Palantir, Tesla, they're going to go up 10 times, right? That's exactly what's going to happen. All right. Every dollar spent from the TGA reappears as reserves in commercial banks, temporarily easing liquidity pressures created by the Financial Reserve's ongoing QT, quantitative tightening program. For risk assets, including tech-heavy NASDAQ, these liquidity injections have provided a tailwind, mitigating the tightening pressures from QT. And guess what? QT is going to be over. I think the plan is for QT to wrap up in May. So once the Fed stops selling bonds, and then the Treasury Department moves out and finishes up the TGA. So there's going to be some kind of, we're going to have to figure out which side of the equation goes where. Okay. So one side is injecting, the other side is tightening. Then the one side will stop tightening, the other side will start tightening, or something like that. I have no clue. But this is why I think this whole year is going to be sideways. So it's great for trading. So one moment we're going to have a bump up in the stock market. Then the other side of the equation starts stopping, pressing the brakes, and then we're going to slow down again. And all the stocks will start retreating. Something's going to happen like that. So you're going to have stop and go, stop and go, stop and go all year until eventually something breaks. And then in late 2025 to 2026, they're just going to be like, crap, we broke something, and we're just going to have to restart QE and restart pumping money into the freaking system again, and then it's gonna go back up. Everything's gonna go up again. So that's what we're gonna have to look at. Was this written by my ex coworker? Oh, you're talking about the tweet? Yeah, could be. All right. So now that the debt ceiling is back in place, we already see that the TGA is draining with the Treasury spending down its cash without offsetting it with debt issuance to maintain cash balance. We therefore have a continued broadly bid on equities and will continue to see passive flows. So in essence, in summary, stocks go up. All right. So anyhow, so this is where the bearish thing goes. It's like, oh, well, this thing is not going to be for here forever, blah, blah, blah. Latin America had the same thing, blah, blah, blah. Okay. So this is a fragile balance. The interplay between fiscal and monetary policy has reached a critical juncture. Yes, that's why I said the Treasury's liquidity injections driven by its need to manage the TGA have temporarily masked the tightening effect of the QT, propping up asset prices and delaying the full impact of monetary policy. But as the TGA drawdown ends and the Treasury pivots to replenishment, this dynamic will reverse, intensifying the liquidity drain from QT and creating new challenges for markets. So we don't know what's going to happen in the future at this point, but for now we're getting some money. Okay. And also, like, tax day is also important too, because Yeah, once they get tax receipts from everybody paying their taxes in April, that also will affect things. So yeah. Okay. I'm done with that. Let's see if I'm ready to talk about real estate now, or do I have another one? I think here I'll give you one more. Hold on. Or Valentine's Day. Oh, Valentine's. So this is the person Samantha was talking about. So let me give you the link here. Okay. So you can go to that one. So this is the one from a Substack. So let me see what's a Substack. Beelzebub. Yeah, great name for a Substack. Beelzebub.substack.com. And I archived it. So, and we're going to go down here. I'm not going to talk about SOFR. I've talked about that before, like maybe back in October. Reverse repo market, talked about that like last week, I think. Treasury general account, this is the one we're talking about. So the TGA has been a key focus, right? Regardless, the Treasury is currently unable to issue debt to backfill spending. So all equal, there is no negative drag on liquidity there. As the balance moves down, the only backup is the emergency measures, which are all not negative domestic liquidity and tax receipts. Okay, yes, they're waiting for taxes, all right, to come in. People got to pay their taxes, all right. We got the QE, QT, blah blah. Oh man, this guy goes through everything. It's really interesting, and then how it affects Bitcoin in the end. So a lot of people do go into this analysis here. Wow. All right. Yeah. Let's see. Liquidity added 125 trillion week over week. Okay, he's going into detail. I actually made a script on TradingView that can do this automatically. Yeah. I haven't paid attention to it for a while. But I guess now it's going to be important again. This liquidity stuff here. Man, these guys go into more detail than I ever did. Wow. So, yeah, I guess we're still having a lot of liquidity. That's good. Oh my God, this guy. This guy's serious. Yeah, some people take this stuff really seriously. Wow. They got the global liquidity, and they got China liquidity here. Man, this guy mapped this whole thing out. Oh man. Wow. Okay. So you got the US, you got China, and you have the global total liquidity injected. All right. So let's see. This quarter, Q1, we're here. Is this a good sign or not? All right. Well, hopefully it goes up, because if I'm thinking the stocks are going to get pumped, we got to get pumped, man. Cybin. I think I heard of Cybin. Is Cybin one of those psychedelic stocks? Because I bought a tie today. So yeah, I think it is. Yeah. So a tie got Peter Thiel back in. So I'm in the tie. They did an offering, so it was down 20%, and I bought it back. So yeah. So who the heck forecasted at 190? Holy shit. Sovereign wealth fund. Yeah, that's a good question. Maybe I should do a separate stream on that. Oh man. Yeah, it is a big deal, but that's a whole nother thing. Yeah. Especially when you look at Saudi Arabia and China and yeah, so more so Saudi Arabia. Yeah, I think it depends on where they want to go in the future. Yeah. TradingView has forecast now? Come on, 190. Oh, man, you guys are crazy. Shit. Here. If you want to do my psychedelics, ATI, ATAI. I got my DMT, and I got my magic mushrooms. So MNMD, ATAI, and yeah, today was down like 20%. I bought it. I bought it. Bought it back, baby. So we were dancing here close to the resistance. Once we get up, we're good. We're good to go. Good to go. Yeah, Sybin's in. Let's see. I don't think this chart has looked good in a long time. Yeah, this chart is like, what the F is wrong with this one? And then there's another one too, outside of Sybin. There was a fourth one. I forgot what it was called. Compass Pathways, also a bad looking chart. So unlike MindMed and ATAI and MindMed are both cleared to go. We got FDA results. I think MindMed has FDA approval, which started the run in March of last year. And ATAI last week got FDA results on its DMT drug. So there you go. We're good to go there. Yeah, so they probably got it from like some analysts or something, you know. These analysts always say whatever the heck they want. Like I bet you if you did analysts and the analysts, they'll be like Palantir should be at $7. Analysts hated Palantir all the time. They always said Palantir should be $7. Just stay at $7 or even $5. But now Palantir is like at what, 100 something? Yeah, you gotta trust them analysts, man. I don't care what its true value is. I think right now Palantir is the most overpriced stock in the S&P 500 right now. Palantir, whatever, man. I don't care about fundamentals. I just go with whatever the pigs are buying. Right? People want to buy it, they gotta buy it. Okay, so I'm going to play this video about the housing market. So there you go. Oh, fund sentiment leaderboard. Oh, okay. All right. Yeah, no, I just remember I had that on my watch list for a long time, but it's just been a stinker, you know. So I just stick with ATAI and MNMD. Once it got some FDA approval on its sales, it's just like, okay, just stick with those two for now. I'm not sure how the other two are in the FDA. That's why I hate drug stocks, but you know, I'm only gonna play them because they got the marijuana and the thing, because a lot of the marijuana folks that they're still stuck in marijuana stocks. The problem with marijuana is like the margins are super thin. The competition is very high. And a lot of them in Canada, the Canadian marijuana like companies, they're taxed to death. So it's like if I just bought weed in Canada, why don't I just buy it from some dude off the street? It's just like ridiculous. Also, you gotta, it's kind of like alcohol too in Canada, where you have to buy from a government store. So you got to buy weed from the government store. So it's like it's really painful, I think, the way they do it over there in Canada. Anyhow, give me go some real estate. I think we got some time here today. It's just 1 hour and 18 minutes, so I can do a 2-hour show for you guys. So this guy might be an H-1B visa person here. Let's see.
Actually, what I kind of specialize in, as Andy has said, is the 18-year economic cycle. Now, you might know it through various sort of guises. Those who study GAN might talk about the North Node cycle, or the Saros cycle, or various other things. We can come on to kind of correlations. I'm really talking about it slightly from a fundamental economic point of view. And I know that we're cycles analysts and some of us are technical analysts and so on. And we don't necessarily always kind of relate what we're seeing back down to fundamental kind of laws of economics. And that's fair enough, because ultimately all we need to know is, if you want to make an investment call, you just need to know which direction the markets are going to move in. You don't necessarily need to know why it's happening. But nonetheless, as Andy mentioned at the start of his introduction, I came to all of this kind of knowledge and interest and study when my family's business went through pretty difficult times in 2008. And that was because banks had called in loans from small businesses, and for small businesses that are reliant on bank credit for perfectly normal reasons, it was almost terminal. And it's taken us the best part of a decade to see through some of those problems, and they're still to a certain extent with us even now. And so I thought it was kind of really kind of impossible that we weren't given some advance warning about why these things took place. And I thought, I'm going to try and understand what went on and what we could do to be prepared, because when I say prepared for the next one, because it seemed fairly obvious to me that there was going to be a next time, and I didn't want my family to experience the difficulties that we had in the aftermath of 2008. Yeah, so I think that's kind of where I started. Subsequently have come across a lot of research, actually. I mean, it's a fairly niche thing about how these things work. And I've, as Andy said, I work with Phil Anderson. I work with a few other people. I work with some businesses on a consultancy basis and so on, to really try and help them navigate the ins and outs of the economic cycle, which is ultimately responsible for all the financial crises that we see periodically in our economies. And once you understand that, I think you can make some fairly prescient forecasts. And if any of you are familiar with my work and Phil's work, I think you will have seen some of that. And just to kind of reiterate how wrong people get the sort of ebbs and flows of the economy, I've got a few slightly provocative slides. I've sort of started this by saying, does anyone really know what they're talking about? I mean, and since the beginning of 2023, well, actually since late 2022, when the UK gilt market supposedly almost blew up. Actually, it didn't, but there was nonetheless a lot of panic for a couple of days. We've kind of been on the sort of precipice of this idea. I mean, maybe it's dying down a little bit in 2024, but this is quite different to where we were this time last year. And we started last year with saying it's going to be the most anticipated downturn ever. So it was virtually guaranteed that the economy would be in recession, that we'd have a major sort of crisis of some sort. This is from Bloomberg. Most anticipated recession in US history, which of course has not happened. So what's going on there? The World Gold Council is always sort of keen to use opportunities like this to plug their strategic assets and so on. I mean, clearly, something was virtually guaranteed to happen. People didn't really know why it hasn't happened. I've not seen any sort of useful explanation proffered as to why they felt they got it so wrong. We got to March of last year, we had the Silicon Valley Bank crisis, the largest bank failure since 2008. Clearly, financial crisis was about to come, and we all know from 2008 what financial crisis means. Again, we didn't really get that. Then we got to the summer, Morgan Stanley saying commercial real estate, and a lot of these small banks that was experiencing problems had overdone their lending to offices and so on. Of course, with working from home and so on, commercial real estate was really under pressure. And according to this, and this was by no means unique commentary, things would crash harder than the great financial crisis. Now, well, I'm not saying that commercial real estate is something that you want to be invested in at the moment, but certainly hasn't been in crisis mode in quite the way that it was that people anticipated. Now, what is it about all of these things that people get wrong? Going back, and it's not just kind of post-COVID, there's a lot of big adjustments in the economy and so on. People could say, well, actually, all the stimulus, all the kind of yield curve control, all this thing has, pushed economic relationships into a different mode. And then the Federal Reserve panicked and raised interest rates from 0 to 5% in a very short space of time. Maybe that's broken something, and therefore it's understandable that people don't necessarily can anticipate the ebbs and flows of the economy. But it's not just a new phenomenon. I've been studying this for now 15 years. My friend Phil has been studying it for longer, And you get these things periodically. Ray Dalio in 2020 said cash is trash, you should be fully invested. Trump was talking about an economic boom, the likes of which the US had never seen. You know, we all know what happened there. It was slowing. They clearly had missed something. It was the panic that exacerbated, the COVID panic exacerbated what might have been already a slowdown. In 2019, everyone was downbeat, and this is, you know, Davos is always a good place where the great and the good get together and provide a commentary on what they're thinking, which tends to set the narrative each year. 2019, very downbeat. They talked about, you know, technological developments taking away jobs. They talked about people being very angry. They talked about trade wars and so on. And of course, we know what happened in 2019. The markets were up all year, but maybe not just politicians and their sort of the ways they talk. You know, you get some really smart people.
So here, I'll tell you this. Maybe I'll go back to this article here, because I talked about this briefly, maybe many times already. I do believe that, yes, COVID was done on purpose. 2008 was done on purpose. Yeah, but if I say that stuff on YouTube, I'll probably get yoinked. So, but let me see. Let me go back here. Let me see if I got this article here. But I did mention this in previous streams. And if you go to McClellan, so McClellan, so the mechoscillator.com, all right? And he's got plenty of old articles. You can go through them. But you can see here. Look at this chart. The Fed's manipulation of the banking system via repos. I didn't talk about repos. Okay, reverse repos is another way of controlling the markets, liquidity, and all that. TGA is the other. So the fiscal side, under the Treasury Secretary, under the President, they have the TGA, and on the Fed's side, the Federal Reserve side, you have reverse repos. And you have QE. QE was something new, because before they used to use repos and reverse repos to drain and inject liquidity into the markets. And then 2008, they introduced the QE thing. So what happened here? So let's look at here. The Fed was quite active with repos in the 2000s. As the size of the repo book waxed and waned, stock prices responded in kind. The Y2K crisis and the 9/11 attacks brought temporary shocks to the financial system, which the Fed met by throwing money at them through the repo system and in other ways. The Fed's manipulation of the banking system via repos became a big problem in 2008 when they inexplicably, you want me to repeat that word how many times? Inexplicably, okay, whatever, decided that it was time to cease doing them, triggering the financial crisis in the process. So September 2008, Fed pulled the chair away as Lehman collapsed. So they could have kept this thing going and injected more money into the system, but they decided, nah, never mind, we'll take it away. And then so it was already about to crash, and then it just completely crashed. So they eventually came up with doing quantitative easing. Oh, great. So I get to use this new hammer tool here I made called QE, quantitative easing, starting in 2009 as their new way to push money into the system. But repos are still a thing, and the Fed still turns to them from time to time. 2020 was a great example of the Fed doing that and of it turning out badly. Right, so we had repos coming in. So guess what? If you remember 2018, we had a lot of problems with the stock market caused by the junk bond market. So the junk bonds went crazy. They stopped raising interest rates in the early 2019, and then late 2019, you had all these repos coming in. So somebody was screaming help, and they were injecting money. But it probably wasn't good enough for about 6 months. And then maybe that's when they decided, oh, might as well just do COVID and do QE again. So now we're going back to QE again, because that's the great way to solve all these problems, is going back to QE, 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 QE. So, well, the internet bubble was Y2K. So essentially, the internet bubble got killed by Y2K into 9/11. Actually, if 9/11 didn't happen, it might have bubbled up again. So yeah, so I remember those times. That's how I got like Apple at like $2 or whatever. Yeah. If my parents kept Apple all the way through, it's probably like what 30,000% or some shit. Because they bought Apple at like $5,000 or $10,000. $10,000 worth of that shit at $2. Yeah. So yeah. That was all around the same thing. So that's the Y2K and yeah, that stuff is the internet bubble. That is the internet bubble. Okay. So anyhow, so I'll give you that link. I've read this a couple times already, so I can put this link here. But that's not what this discussion is about. It's just about the real estate stuff, and it's just incidental that real estate had something to do with 2008, just because of the toxic stuff. Yeah, I had my first Nokia too, and actually, you know, in Europe you had like the first internet phones. So I had one of those. So in America, I was one of the first people that had internet phones, and all you could do was play dumb stuff. Like you could just browse using text, and then you could play little internet games. But it was very primitive, you know. Yeah, very primitive. But it was the first one that had internet, and that's why I had for a longest time. I was grandfathered into an unlimited internet plan for a long while until I got to my first iPhone. And then the first iPhone, what happened was, yeah, the AT&T realized, hey, you got a smartphone. We don't allow smartphones on the contract. And I was like, what the fuck? Fuck you. Man, I could have had unlimited internet all the way up until now for like $10 a month for like the whole family plan or something. If you had a lawyer, you could probably sue them and be like, hell no, we're not going to change the plan. Anyhow, whatever. I'm not. Good old times. Good old times.
Talking about, and this was back in 2014, hyperinflation because of all the QE, and that was actually precipitated the gold crash into 2016. Ben Bernanke, of course, great moderation. I put this up because this is kind of the equivalent point in the last 18-year cycle, talking about the great moderation, decline in macroeconomic volatility, which in other words is code for I've solved the boom and bust cycle. We had similar things in the UK around that time. Gordon Brown, who was in charge of the economy, said he'd solved boom and bust through his prudent financial management. And of course, we know that things did go up for a couple of years and then came crashing down. And Ben Bernanke had to say during that period that September and October of 2008 was the worst financial crisis in global history, including the Great Depression. And he should know, being a student of the Great Depression. Now, clearly, people are missing stuff. I mean, it's not just them. It's not just politicians. It's not just big fund managers. I think we've had 18 months of people being very certain about what was going to happen. It hasn't happened. So what's going on? What is it that everyone's missing? And that's really the subject of what I want to get onto. Very famously, the Queen went to the LSE. Andy mentioned the LSE at the start of the presentation. 2008. This was just about, I believe, November 2008. It's about 7 months after Lehman Brothers collapsed, and the Queen was opening a building. And she went to the LSE, and she'd sort of wanted a briefing on what the hell was going on to the UK and to the global economy. And she got a presentation, and they talked about, there's lots of imbalances. Chinese are saving too much money. It's pushing global interest rates down. It's inducing speculation. We have a financial system that's interrelated. There's regulations, but no one's got oversight of the whole system. And therefore, no one really knows how all of these things fit together. It's the kind of usual explanations that you get. I went to a talk at the Systemic Risk Center in LSE last week, and it's very similar types of conversations going on, i.e. these things are really complicated. There are new instruments. There's, Bitcoin, there's crypto, there's, leverage built on that. We don't know how this is all going to play out. And I think while there are certain novelties to the current era, there's obviously AI as well. I don't think that anything that has happened is particularly such a leap change in economic development that we haven't seen something equally impactful in the past. And I talk in my book about, the impact of the railways. To my mind, a much more significant technology than potentially AI in relation to where the humanity was before the railways. So maybe you can park that and we can have that kind of conversation in a second. So what are they missing? So very, very simply, and I'm going to outline the contours of the 18-year cycle very briefly. We can go into more detail during the Q&A. The proposition is that there is a very regular 18-year cycle, and you see it most clearly in the land market, in the property market, but actually it's an economic cycle. And so what this graph does is it shows the progress of the US in terms of its land sales. So as you know much better than I do, after 1800, when the 13 states of the US ceded their sort of, what do you call it, their rights to Western lands to the federal government, the federal government then proceeded to sell off the land. You went out into the frontier and bought, I don't know, whatever you wanted for $1.60 an acre and so on. And the progress of land sales shows that actually things would go sort of fairly steadily for about a decade, and then they would crescendo into a peak in 1818. And after that, you would get a major drop-off in activity in terms of land sales. But actually, if you read the historical record, you found that actually it was a kind of fairly significant banking crisis and an economic recession. And actually what it was that, a lot of the activity in the run up to the peak had been built upon people borrowing money to speculate in land, in property, and so on. And the economy kind of supported that for a time, and then it could take it no longer, and the entire thing collapsed. Then things would recover a few years later. They'd go steadily into another crescendo. And the second one was in 1836. And then you had a major depression after that, the depression and crisis of 1837. Andy, I know, has written about that quite persuasively. And it was a very significant, probably the first really significant financial crisis in US history. But then things recovered to another peak 18 years later in 1854. And again in 1869 was the peak. 1873, 19 years later, was the crisis. 1888, a couple of decades later, that kind of things bubbled on around the top, things came down, and we had a major depression of 1893 and so on. And so for the first 120 years of US history, until about 1923, when frontier was closed, you had these very regular 18-year cycles of boom and bust. In the aftermath, there was a major financial crisis. Then in the 20th century, we had probably the most famous boom of them all, the Roaring '20s. The land market peaked in 1926. There was various factors which led the stock market to have another couple of years. The land market was doing nothing. Agricultural market was in depression for most of the 20s, but the commercial real estate market, because of tax incentives, because of low interest rates, and because of the enormous amount of money that had been created in the 20s, pushed the stock market up for another couple of years. And then we had the major crisis, which presaged the Great Depression. And so on. After that, things were interrupted. The Second World War, of course, when you're fighting a total war, things aren't going to be quite the same. But after about 1955, 1956, things started to reset. And on the next slide, you see a graph of property prices in real terms in the UK and the US. And so things reset in 56. We had a peak in 1972 in the US, in 73 in the UK, and then a major financial crisis, which in popular imagination and amongst actually some fairly educated financial commentators was entirely down to the oil shock of 1973. Not at all. It was a declining property market that was pushing the economy into recession, that was then exacerbated by the oil shock, which created the problems of the 70s. But we would have had a fairly significant recession, if not depression, in the absence of those geopolitical events. Nonetheless, things recovered in the late 70s up to the boom of the 80s, to peak at around 89, 90 in the UK. Very famously, the biggest boom and biggest bust was in Japan. Again, very much property-led and so on. And it was so severe in terms of their crisis that it's taken pretty much 20 years for them to get out of it. By about 1993, the US was recovering. Clinton, it's the economy stupid, it's all that kind of stuff was going on at the same time. We had the dot-com boom. We didn't have a crisis after that. That came down. We had, stimulus and so on. It pushed the economy into new heights in the 2000s to peak in 2006 in the US, 2007, and then of course the global financial crisis. So pretty much for the entire history of the United States, and very significantly for all of modern UK history and the history of other countries in Europe and so on, after they've been independent or established the current format that they have now, countries joining the international system like Japan after the Second World War are exhibiting very much these 18-year cycles of boom and bust, very much linked to the land market. Now, it's not just a case of waiting every 18 years for a major recession. If you study each episode in detail, and it's set out very well in my friend Phil's book, The Secret Life of Real Estate and Banking, and also in my book, The Secret Wealth Advantage, you can discern a sort of fairly regular pattern within it of 18 years on average. And actually with not much variation. And sometimes it runs a bit longer to 20 years, sometimes it's a bit shorter, but really that one of the uncertainties about all of this is that we don't properly measure the land market, and that's where you see the cycle most clearly. Nonetheless, the 18-year period is divided into roughly 14 years of expansion and 4 years of peak, crash, and recovery. And those 14 years of expansion themselves are divided into roughly 2 7-year halves, interrupted by a mid-cycle recession. And the mid-cycle recession tends to be much milder and shorter than the end-of-cycle recession, which actually, in technical terms, is probably an economic depression. And this is when the most significant problems in the banking system, the most significant reductions in output, the most significant problems in kind of social relationships and so on occur. So the first, I've divided in my book into sort of 4 phases. The first phase is the recovery and expansion, the recovery out of the prior cycle lows, and it expands for 7 years. You then get the second phase, a mid-cycle recession, as I've said. You get the second expansion, which is very much more obviously land boom, which finally in the last couple of years accelerates into a bit of a mania. And I will go through some of the telltale signs of a mania. And then that leads into the major crash and requires a major bank bailout and so on. In this, and this might be slightly more closer to your heart in the sense, I don't know if you're property investors, but I think you're all stock market investors or traders. In this chart, all I've done is I've taken Dow data back to 1800. I've chopped it into roughly 18-year segments. I've kind of averaged it out. And what you get is a relatively similar pattern to the previous chart. In other words, things start slowly, they expand through the first half of the cycle. You have a mid-cycle slowdown. It either consists of the markets going sideways for a couple of years, or the markets coming down pretty hard and going straight back up again as they did in 2020. That leaves to the second half of the cycle. The stock market tends to be even stronger in the second half. It almost invariably gets to major new highs. I think the 1860s was the only one where it didn't, and that is probably explained by the US Civil War. But otherwise, it goes into all-time new highs, and then you get a major peak and crash, and you can't really see it properly because of the scale and so on. But and also because I think I had to exclude some data just to kind of make the sort of segments fit. But the median fall in the Dow Jones over that period is 48%. And obviously, if you're invested in particular sectors like the banking sector, property sector, the downturn at the end of the cycle is even greater. So these are major significant stock market events. Often take several years to sort out, several years before you're if you're invested all the way through it, and people usually sell out at the bottom. If you're invested all the way through it, it takes several years for you to get back to where you bought in, presuming that you bought in at the peak, which, of course, as we know, investing is an emotional game and people tend to get sucked in at the peak. This sets out some of the past forecasts. I mean, just to show that, we have, Phil and I, consistently put our kind of our forecasts out into public in this sort of Money Week magazine, which is the largest financial publication in the UK, to kind of set out some of the, how the cycle works and what we see going forward. Now, the obvious question is, where are we headed? So the current cycle started post GFC around 2011, 2012. There's never one single day when a cycle particularly starts. It's a process. You know, you've got to get through the problems of the last cycle. The banking system needs to be put on a sounder footing. The US and the UK did it much more quickly than, say, Europe after 2008. And so it appears that the US started around late 2011, maybe early 2012, when the land market bottomed. After that, you would have expected 7 years in, 2019, 2020, for there to be a mid-cycle recession. You can finesse it a little bit using other cycles as you get there close to the time. We definitely had a pretty short and sharp recession in 2020. It wasn't all COVID-induced. There were very many signs that the global economy was heading into some kind of slowdown in 2019. Then, nonetheless, stimulus worked very quickly. They overstimulated, clearly, because I don't think they realized what they were dealing with in relation to the pandemic. But nonetheless, if 2019 is the start of the mid-cycle, it would then put you in relation to the peak of the cycle around 2026. And what you notice if you study your history is that very similar things happen at each phase of the cycle. I outline all of that in my book. I break the cycle down into several.
Yeah, good night, Joel. What's up? Yeah, you can watch this later. I'll go over an article on real estate after I'm done with this one.
Stages, and I say, here's what happens at each stage based upon a reading of history. Now, just to take where we are in the cycle and sort of kind of go through a little bit of that. And some of this relates to markets and things that you might be invested in. And sorry, the yellow dot should be a little further to the right. I need to update this chart. So we are sort of on the cusp of the really frothy period leading to the peak in 2026, which is the kind of forecast date for the peak of the cycle. So you get looser monetary and fiscal policy. We've certainly had that. You often get spending for public works, i.e. infrastructure. We've certainly had that. And we're not just talking about the US, I'm talking about globally. This brings and induces a commodities boom because demand for raw materials and so on, and trade is expanding and other things. And big countries are sort of vying to compete for various access to raw materials. You get the era of very easy money. Now, you might say we've already had that and we're tightening. What I really mean is really profligate bank lending, and we're not quite seeing that yet, but you certainly see the signs. Lending is particularly lending at 5% or whatever it is very lucrative for banks, and they're really trying to find ways to expand their balance sheets and so on. And where they're not successful, non-bank lenders are coming in. So it's really an era when people are really encouraged to borrow as much as possible. And one of the very telltale signs of a peak is the fact that you get a series of announcements about the world's tallest, longest, largest, deepest structure. And that is partly because it brings together three of the things that you always get at the peak of the cycle before a major crisis. And that is high land prices, such that building higher is needed to make the site pay, easy credit, because of course you need to borrow a lot of money to build these things, and a sense of optimism, hedonism, even that the business case for such a building makes a lot of sense. Certainly not the sort of thing that would get past run up to the run up to the peak.
Sorry, can you
and then after
can you
that,
hear me?
Sorry,
I was just asking a question, if that's okay.
Oh, sorry. Yeah, sorry, I didn't hear you.
Yeah. This era of very easy money. It's interesting what's going on with private credit right now. This whole movement of private credit, right, that didn't really exist before, of the lending kind of moving out of the banks and into the BlackRocks, et cetera. Any comment on that?
Yes, it's a repeat of history. If you go to 1990s, 80s Japan, you had the sort of conglomerates, you had the sort of industrial companies, all of which were allied to one of the major Japanese banks that did a lot of lending. But really, in the couple of years before the peak, it was all the non-bank lenders that got in there. They weren't bound by the same banking regulations, and they had a lot of surplus cash, which they'd raised from private investors. And they were really pushing money into the market such that banks, if they wanted to keep up, had to find ways of getting around the regulations. I see what's going on with BlackRock and others having the same impact in this cycle as it did then. And there were certainly things in the 2000s which really pushed lending into overdrive. New structures, ways of originating the loan and then shifting it off the balance sheet and so on. So it's very much a product of the present era.
Yeah,
I think the key thing is, is the scale. So it's not like people invented securitizations in 2004. They were around as a financing vehicle since probably the 70s or 80s. But it's the extent to which people push that at scale once you've had several years of the cycle that I think is really the key point. All right, a final kind of slide. So world's tallest building marks the peak. This is the Burj Khalifa in 2010. They're always open in the crisis. This is the Shard in London, and you'd be familiar with this, which is Europe. Well, at the time, was Europe's tallest building, opened in 2011 during the crisis. Petronas Towers in 97, world's tallest building at the time, opened up during the East Asian financial crisis. This is One Canada Square in London, again, Europe's tallest building in 1990, opened during recession. 74, Sears Tower during the crisis, and probably most famously of all, the Empire State Building, opened in 31. I believe it was called for many years the Empty State Building because no one could afford to pay the rents in them. So, it brings together all of the elements that I've mentioned about the cycle, about markets, about optimism, about kind of somewhat crazy behavior. And was, I think Oklahoma City, of all places, has announced the tallest building in the US, I believe. You get sort of really odd things like this in the run up to the peak. And of course, what's going on in the Middle East, what's going on in Asia, are examples of that.
You could say the world's longest building, right?
Yeah, there's a sort of NEOM thing and
like
so
the
on.
10-mile long building or something.
Well, exactly. I mean, who knows how long that will take to get built? But the idea that you don't announce these things in 2009, 10, right? You announce them when things are going over. Other examples. I mean, you got the Taylor Swift $1 billion Eras tour. You've got crazy sums being spent on sports team and so on. I mean, it's actually really interesting times to write about. You kind of really understand where some of these things come from, but we are going to see quite a lot of that. And I think really it seems fairly crazy to me, probably because I'm getting a bit old now, but there is I think we haven't seen anything yet, to be honest. I think this cycle, it's going to get pushed.
Okay, so I think you have an idea of where we're headed. So that's why I always say 2026 will be the peak here. Okay, what's up, Ignat? So I'm going to end this by reading this blog. So let's see where we're headed. Neo-feudal review. So I found this guy pretty interesting. Pretty doomerish, right? I love the doomer stuff. Gotta read that doomer stuff. Let's go. Let's go here. Sprinting towards 2030s. I own nothing reality. Housing inflation for new buyers is at least 20 to 30% per year. Since 2020, the cost of new home ownership in the US has risen by at least 20 to 30% annually. While official figures show modest overall inflation, the real price increases are far higher than that and felt most acutely in housing, with home prices climbing by 50% and mortgage payments more than doubling for new buyers due to soaring interest rates. This post explores the main factors driving this surge, including supply shortages, rising construction costs, and the impacts of government policies. I have made the claim at various points that the real annual inflation is currently at least 20% in the United States, even though the official rate of inflation was only 2.9% in 2024. By real inflation, I'm referring to the rising costs of housing, food, healthcare, insurance, both home and auto, cars, education, and utilities. Some categories have been slower or even negative inflation, such as televisions, internet, and phones. See here from 2018. And yes, electronics is one of those things that keeps going down in price, and that's why I say in some areas, in some fields, electrical engineering and all that, somehow we're the only guys that try to reduce the prices of things and increase the functionality. Very strange. Everybody else wants to raise the prices. Official statistics are manipulated downwards to a comical degree for political reasons. When I tell people my estimate of real inflation rates, most people look back blankly, unable to process what I said. I'm not sure if they think I'm joking or if I'm glitched out their brain. Without an expert on television or writing telling them that real inflation is massive, are most people going to process what's in front of their eyes? Hell, a sandwich eating out is now $15 to $20. A typical sit-down dinner is $40 a person, and a steak dinner is $100 plus per person, at least in urban areas. This is double what it was pre-COVID. Do people even notice how fast prices are changing? In this post, I'll focus on one specific aspect: home ownership inflation. This builds on earlier discussions about our shift into neoliberal feudal system, where the concept of owning nothing and being happy is becoming a reality thanks to the elites driving us towards Agenda 2030. For context, check out this Archive Forbes article. They later deleted it, titled "Welcome to 2030. I own nothing, have no privacy, and life has never been better." It begins with "Welcome to the year 2030. Welcome to our city, or to my city, or should I say our city. I don't own anything. I don't own a car or house, any appliances or clothes. This reflects a vision of techno-communism, where everything is owned by the elites." All right. For a deeper dive into these topics, you can explore posts like "The Wage Cuck as the Antithesis of Both Fire and Neat," and "The Era of Empty Secular Mass Consumption is Over." Oh, this is going to be great, huh? The key discussion point for this post is that the cost of home ownership has surged since 2020 despite 30-year fixed mortgage rates rising from 2.5 to 7%. This is highly unusual because typically there's a strong and direct inverse relationship between interest rates and asset prices, i.e., lower rates allow people to borrow more, which will drive prices up, while higher rates reduce borrowing power and loses lower prices. We'll explore why this relationship is not tracking for homes now. According to the Federal Housing Finance Agency, FHFA, the average purchase price in the United States went from $300,000 in 2020 to $450,000 through the end of 2024. Okay. The HFFA House Price Index (HPI) focuses on changes in the price of single-family homes based on actual sales transactions. The HPI tracks price changes over time in specific geographic regions, adjusting for factors like home characteristics, size, location, to ensure it reflects only price changes, not shifts in the type of homes being sold. A 50% increase in 4 year equals 12.5% price appreciation per year. Okay, that's interesting because I did play this video. Here, let me see if I can find it. Talking about the composition of homes being built in America, changing from single family to multi-family units. Okay. So I played this one before. I thought it was pretty darn interesting. If only I could find it again. Must have been quite a while ago, huh? Let's see, home. Nope, nope, nope. Okay, I found it. Here we are.
Raised interest rates faster than ever, but the economy hasn't responded like normal. So is something broken? Not quite. The answer, like usual, lies in the housing market. In this video, we'll explain the longer than normal lag time between leading indicators and broader economic growth and employment. Leading indicators, like building permits, show where growth and employment are headed. They're not magic, they're mechanical. You need a building permit before you start construction. Historically, when building permits dropped, construction activity and employment quickly followed. But after the pandemic, the lag time between a decline in permits and its impact on growth and employment exploded. Why is that? From the 1980s to the early 2000s, it took 6 to 7 months to build a single family home. After the pandemic, this spiked to 9.5 months before returning to the more typical 7.5 months. But the real story lies in multifamily construction. Multifamily units inherently take longer to build, about 16 months versus 7.5 months for single-family homes. Over the last 30 years, we've shifted towards building more multifamily housing. In the 1990s and 2000s, 20 to 30% of all units under construction were multifamily. Today, nearly 60% of all units under construction are multifamily. The time to complete multifamily projects has skyrocketed. In the 1980s, it was about 10 months. Pre-2008, it was about 20 months. And post-pandemic, it hit over 30 months. The time to complete all housing units under construction, a blend of both single-family and multifamily, hit a record of more than 14 months during the pandemic. It's now back to 11 months. Why is this so important? One of the main channels by which interest rate hikes slow the economy is by reducing building permits and making new construction projects financially unfeasible. But with a 30-month backlog of multifamily construction, the economy hasn't felt the full slowdown yet. Now that backlogs are shrinking and construction timelines are normalizing, the effects of lower building permits will finally start to show up. If building permits stay low, construction will slow down and employment will fall as leading indicators implied, but with a really long lag time. The bottom line is that leading indicators like building permits still work. They have to because it's mechanical. But the shift towards multifamily housing and longer construction timelines has massively delayed the impacts of rate hikes on growth and employment. Things can invariably change, so it's always important to monitor the sequence of events and the sequence of the business cycle. If you found this video helpful, don't forget to like and subscribe for more insights on the economy. And if you'd like to dive deeper into business cycles and our 4 economy framework for tracking the business cycle sequence, visit epbresearch.com. The link is in the description box below. Thank you for watching, and I'll see you in the next video.
All right, guys. Yeah, so I played that before. I put the link in the description. You can find more of those videos, but that is pretty important because this guy in this blog, I don't think understands that. Okay, because we are not doing single family houses anymore. And that's probably why you're going to see this kind of disparity between like, oh man, why isn't the economy crashing? Well, you probably got to wait another 14 months. Hold on. We're not at 2026 yet. All right, continuing on the article, the S&P CoreLogic Case-Shiller U.S. National Home Price Index also shows a corresponding roughly 50% rise in cost from 2020, while the FHFA HPI index is meant to track dollar for dollar. The Case-Shiller HPI shows relative price changes over time, but doesn't directly provide the price of homes in dollars. A monthly payment at 6.95% is about 64% higher than it would be at 2.70% for a 30-year fixed mortgage at the same home price. A 50% increase in the home price and a 6.9% interest rate combined with an original 2.7% interest rate leads to a monthly mortgage payment that is more than double the original payment at approximately 146.2% higher. Divide by 4 years, and that's a 36.55% increase in the cost of mortgage payments, or divide by 5 years, and it's a 29.22% increase. Another way of looking at it is house payments as a percentage of median income. Here we are. That 2024 rate is higher now as interest rates today are higher. Oh boy. Well, we're at the bubble territory, aren't we? We're at the bubble territory. So watch out, guys. Let's go. Let's go. We're going to get that bubble to pop. All right. Share of income needed to afford a typical home dropped slightly in 2024. So it's now at 41.8% last year. All right. Wow. Slightly. Very slight from 42.2%. Income required to keep home payments affordable hits record high. All right, let's go. Let's go. Let's see this thing. Let's zoom into this thing. Let's see what the median household income is needed, and the household income needed, median household income needed. Okay, median household income compared to income needed to spend less than 30% on monthly housing costs for median priced home. Okay. Damn. All right. So the household income needed has popped in the last several years. Okay. So shoot. So median income now is about 80,000. Well, good luck with that. Are you guys in the urban area getting paid 80,000? Oh, well. Yeah, well, when I was in tech, I probably was like nearly 200,000 with bonuses. So I don't know. Even then, I would be like, come on. So yeah, that's how much you need to afford a house now. That's definitely true for California. This shit right here. So 120, 110 needed. Yeah, in 2024, probably now. Yeah. That makes sense. Yeah, probably all the urban areas are pushing these blue bars up. Terrible. All right. Or of course, the cost of home ownership includes other things such as, oh yeah, I forgot about that, property taxes. Well, if you're not grandfathered into a low rate, that's going to be bad. Homeowners insurance, maintenance, and utilities. Yeah. So these costs have also surged massively, 50% over the past 5 years, but they are also location dependent. Yes, very location dependent. Homeowners insurance rates are up 44% nationally over the past 6 years. Well, even California, that's probably like quadrupled or something like that. Okay. Let's see. Yeah, U.S. homeowners effective rate changes, 10 largest insurers. Let's see, 20. Oh, yeah. Wow. Okay. State Farm, 10%. American Family Insurance, 16.5. Overall average, 10.2%. I think I've built a decent case here for how the cost of home ownership has increased at least 20%, if not much more, year over year since COVID. Now, why have home prices increased so much since 2020, even though interest rates have tripled? As I wrote above, it is highly unusual situation. I attribute it to the following factors: a massive increase in national debt to 37 trillion, massive monetary expansion, $11 trillion alone was printed during COVID, and a continuously running $2 trillion plus dollar deficit dramatically decreases the value of the dollar versus, yeah, that's true. Yeah, if you look at the dollar by itself, yes. An estimated 20 million illegal immigrants were let into the country under the Biden administration, straining housing resources. That's right. The lack of new construction during COVID, yeah, that's right. Lumber and all that caused issues as well. The impact of COVID on the global supply chain caused, yeah, right. Let's talk about lumber right there. Yeah, copper also went up. Buildings have faced continual challenges such as labor shortages, rising material costs. Yes, lumber right there. A shift in housing preferences with the increase in remote work. That's true. Institutional investors have been increasingly buying. Yes, that's right. BlackRock, Blackstone, Black everything. Single family homes as a part of a larger portfolios, turning them into real rental properties. Oh, yep. This practice should be illegal, in my opinion. Oh, wow. Recent research by MetLife Investment Management, MIM, estimated that institutions own some 700,000 single-family rentals in 2022. About 5% of the 14 million SFRs, single-family residencies nationally. MIM forecasts that by 2030, institutions will increase SFR holdings to 7.6 million homes, more than 40% of all SFRs, and the lock-in effect from existing homeowners who don't want to trade their low-rate mortgages for higher ones. That's right. That's right. A lot of us don't want to trade houses if we're going to get a higher interest rate. So unless you got cash on hand to buy without having a loan like this, that's a problem. While home ownership rates are not terrible by historical standards, generational home ownership rates are horrific. The silent and baby boomer generation are doing great, while Gen X is somewhere in between millennial home ownership rates that are terrible. Let's not get started on Gen Z. Well, Gen Z, you're fucked. All right, let's see here. Generational home ownership rates. 1985 to 2022, the silent generation is 76.8. Baby boomer is 77.8. Generation X, 69.7%. And millennial, 51.5% right now. That's it. Terrible. And the overall home ownership rate is at 66, just below 66%. We used to have a peak just before the great financial crisis. Looks like about 69%, huh? Okay. Millennials less likely to own their own homes, huh? Percent of each generation living in a home owned by themselves, their spouse, or their partner at each age group. 27% millennials. Oh, great. Asking rent as a percent of blue collar income, 34.4%. Average cost of rent rising faster than rising incomes. Rent growth, 134.9%. Income growth, just 76%. Wow, I'm surprised income growth is even that high. So look, as I've argued, the middle class in America is not dying, but simply dead at this point. Home unaffordability is extremely high, and people have to put an increasingly enormous percentage of their take-home pay towards rent. I believe this to be intentional and engineered, where our upper elites use the magic of financial engineering to lead us towards a predetermined result, which they've always done historically. See the engineered 1929 crash. Oh, yeah. Oh, okay, this guy. All right, he's going pretty far. Oh, they got a 4chan post here for you, too. There will be no collapse the way some of these people think of it. It's not going to be like the movie Dawn of the Dead or whatever, where one day suddenly shit hits the fan and prices skyrocket. And everyone begins to riot, and the SS comes marching down the street to kill everyone. Oh, great. Wow, you got to end that. But okay, guys, you guys can read this yourself. This is pretty doomerish, but but that's I can't really complain or critique too much of what he says, right? Yes, that's right, tropes. Yes, you probably would have to have help. That's right. And this is very important to understand. People need help. This whole boots, do it with your bootstraps type stuff. Yeah, I understand, I get it. There's a lot of that talk going around, and it's just not the same. We're living a different time, different world. So you got to play with different rules. And that's why I'm here, to teach you how to trade stocks, because I know a lot of you need to make capital quickly. And how I did it before was without trading. I just slowly invested, and it worked then, but we're at the point where there's going to be a top, and it's better you have to understand how to trade, okay? And not just meaning about day trading or anything like that. That's not really my end all be all goal, but to understand how cycles work, to understand when to buy copper versus buying real estate versus buying certain sectors of stock. When is it the time to buy tech, right? Tech was good for a while. Now we're moving on to commodities and energy. So these are things. And then later on, then we moved into real estate or bonds or gold or silver, Bitcoin, whatever. There's going to be different asset classes, and you have to know how to rotate among them. So that's the main thing about trading. But the same ideas can also be applied to swing trading, day trading, all this in stocks and futures and crypto. Everything's fractal as long as you understand it. So if you get the big picture, the same techniques will work everywhere. And that's what I've tried to focus on. Okay. So and this goes into the cycle education. So there's an 18-year cycle. We're about to hit the peak. Something's going to happen. No clue what. Doesn't really matter how, but we'll get there. Okay. So all righty. That was good. Let's see what else. Oh, let me end it with this. There was an article today about Intel. I think this is a important one to talk about. Probably we'll talk about it again later. All right, so Intel here. Bard cites supply chain chatter that TSMC would send engineers to Intel's 3 nanometer to 2 nanometer fab. City notes that Intel's microprocessor share is now lowest since 2002. Oh, God, that's terrible. Rohil Salim wrote this article yesterday, February 12th. With Intel under the unorthodox leadership of 2 interim co-CEOs following the abrupt exit of Pat Gelsinger in late 2024, the company appears indecisive at a critical crossroad. Should it continue to plow ahead with Gelsinger's fab-focused winner-takes-it-all gambit, or try to resurrect some shareholder value by offloading its chip fabrication facilities? Today, Bard is out with some distinctive insight into this dilemma. To wit, Bard analyst Tristan Guerra has cited discussions from the Asia supply chain in a new investment note to suggest that Intel might be pivoting towards a closer collaboration with TSMC to get its struggling fabrication units off the ground, so to speak. There are discussions from the Asia supply chain that the U.S. government will get involved in potentially the following. TSMC would send engineers to Intel's 3 nanometer, 2 nanometer fab, applying the company's know-how to ensure that the fab and subsequent manufacturing projects from Intel become viable. Guerra goes on to note the fab could be spun off into a new entity jointly owned by TSMC and Intel and run by TSMC. While Guerra concedes that there is no confirmation or potential completion of this project could be lengthy, he asserts that such an approach would make most sense in the current situation, especially as the newly minted entity would be eligible for CHIPS Funding Act. Under this version, Intel would focus on chip design and platform solutions benefiting from significant cash savings, while TSMC would handle the nitty-gritty of chip fabrication. Separately, in what paints as a stark picture of Intel's ongoing market share bleed, Citi analysts recently leveraged data from Mercury Research to note that Intel's share of microprocessor shipments in the fourth quarter of 2024 fell by 1.04% quarter over quarter to just 67.4%, constituting the lowest in our model's history, dating back to 2002. And if you remember 2002, that was when they had the Pentium crisis, right? Like Intel at that time were trying to do gigahertz at all costs. They were trying to make the most gigahertz they could with whatever they had. And at that time, you had Motorola, IBM, everybody else going like, no. We can't just make a 10 gigahertz processor. That would just be, the computer would be so hot. Like the thermal runaway would be insane. It would have a higher density of heat, okay, per square millimeter than the rocket from the freaking SpaceX, okay? Or like they didn't have SpaceX back then, but equivalent. So you could see this chart showing like if you had a 10 gigahertz processor using the technology we had back in the 2000s, and you did that on a chip, your computer would be a burning hole of complete fire. It would be so hot because the heat density would be so high. It might as well be a rocket. Okay. Yeah. Yeah, I don't know, but India's a mess. I don't know if India's going to help anything with that. Only the Taiwanese know how to make chips at this point. They're the only ones that do it that well. Yeah, India has a lot of other problems. I just don't think only the yellow man can make chips at this. I don't know why, but can't trust the brown man. Only the yellow man. All right. Anyway, Intel's loss was AMD's gain, which managed to increase a microprocessor share by 0.53% quarter over quarter to 22.1%. And, for you guys to understand what 2 nanometer and 3 nanometer, when I was working, I was in school, it was 65 nanometer. Then at work, it was 24 to 14. So now we're at 2 and 3 for like the coming 5 years. That's really advanced, right? So we're barely at 7, I think now. So to get down to 2, I think we're almost at the limits of how things are. So 2 should be very close to the limit of what we can do, and we might be able to jerry rig it to get a little bit more performance. But at that point, I wonder where the quantum computing or other materials will have to come in. So I'm really curious what the next 10 years will be for semiconductors. That's where the challenge will be. Yeah, well, humble president. Yeah. All right. Okay, guys, I'll see you tomorrow, or maybe not. I don't know. I don't know what's going to happen tomorrow. There shouldn't be anything surprising tomorrow, unless retail sales somehow does something crazy. But as you see from what I've said today, and let me go over some more little stocks, but buy them. Yeah, all they could do is they'll just buy them. But man, India's stock market is so funny. I don't know. Shit. I just don't know if I believe like their stock market either. Like they seem to have consumers, but eh, yeah, we'll see. We'll see. Of course, it's always the middle class. And they're always going to compete with China for the new middle class that's growing right now. Okay, let's see. What else we got to look at? So earnings today was Roku, Palo Alto Network, so ROKUPANW. Tomorrow we'll have Moderna, mRNA. Definitely curious to see how that goes. Moderna, definitely important. Okay, we're at a bottom again. $31, $32. Okay, Palo Alto Networks, Airbnb. I think that popped. Airbnb, ABNB, DraftKings also went up to after hours, so definitely watching that one. DKNG. Coin did nothing, but it was already up 8% today, so probably that's why. Twilio went down, so I'm watching that one. It already pre-announced earnings, so that's probably why it's like nothing special. Gonna have to see how that goes. So TWLO, something I'm definitely curious about. Okay, so let me see the weekly chart on Twilio. Okay, let me see. This one's weekly chart. Okay, yeah. Let's see where it dropped. I don't think it's dropped much after hours. So I'm gonna see TWLO. AMAT went down, so that's not gonna help the semiconductors. AMAT. So Applied Materials. See what else. Okay. See what else I want to talk about today. Oh, natural gas. I might as well talk about that, huh? Natural gas. Okay. So it hit a resistance again. Yeah, it hit resistance again. Right here. Right here. So not bad. I think it's trying to hold this range potentially between 3.5 $3.6 a million British thermal units. Okay. and up here at 4 something, right? $4.5. So let's see how it goes. And oil hasn't risen yet, so I'm curious to see if it can break through it or not. Otherwise, I'm shorting it again. Let's see if it goes down to 3.2. And then from there, we'll see how it goes in the spring. That's probably where natural gas will go. And we already had earnings from Williams, so that's up nearly 5%. Have to see what other one. We have Enbridge tomorrow, pipeline company. ENB will report tomorrow morning. So I'm watching that one too. Maybe it'll break out. ENB. Let's see what else. I don't think I got to talk about that one. Intel. I mentioned Intel. So Intel. So this week's been a good week for Intel, but we just run right back up into resistance here, 24.45. Okay, so we're still in this range between 19.25, 19.25. You see that? You see that, right? So we're going to have to see how that goes. So it's helping me so far because I'm long semiconductors in the ETF side. So that's been okay. We have Deere reported earnings. So still good. The stock still looking good. DE. So it held. So it's holding above that area here, 442, 443. So it was still down today, -2%, but it was down worse. I think it was down as much as 5% or something. Let's see. Get my little tool here because I'm lazy to do the math here. Yeah, 5%. I'm right. All right. Yeah, it was down 5%, but it still came back up. So still looks good. See, and then I'm going to look at ARC. So I'm going to show you the ARC stuff. So all the Cathy Wood stuff. Looks like it's ready to rock. So if I see ARC, ARKK, I see these things trying to make a new level here. So look at the monthly. Yeah, it's ready. It's ready. If I see this ready to go, it's ready to go. ARC W. Okay. So ARC W is the internet one. Okay. So this has all the aggressive software ones. ARC W. ARC G is the genomics. This one's still at the bottom here, just kind of like XBI. So biotech is still down. Yeah, it's the weakest. If I see this trying to recover, okay, then I'm more optimistic that liquidity is coming in. ARC F financials, good. So we have like Upstart, Affirm. You already know about those stocks. That's why ARC F is going up. Okay. And then TARK, TARK is like 2x of ARC. And if ARC, ARKK is really going to retest the 2021 highs this year, yeah, okay, that's really good. That's really good. So I'm going to be more optimistic. But, I got to see proof. We're in the little eye of the storm right now. We could just crash in March still. That's still my plan, but I could be wrong. Maybe Samantha Duke's right. We can still go into April. We can still pump into April. Wouldn't that be amazing? Wouldn't that be amazing? All right, guys. I'll see ya. Remember to donate to the fund here. You got the Streamlabs tip jar. Let's see where the Streamlabs tip jar is. Man. Tip jar. You gotta get the tip jar. Get the tip jar. Oh yeah, and email me if you got questions. Crack, CRACK @JGHB. Streamlabs tip jar right here. Streamlabs.com/TheUrbanLandord. And you got Porsche J, right? $, PORSHAJAYE, and PayPal, PORSHA @JGHB.info. Okay, I'll see you guys. Please hit the likes before you leave, and we'll go. Enjoy your evening, and see what happens on Valentine's Day. Oh, Valentine's Day.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like